everyone, I'm Jun, a researcher with The Expert. I'm sure you have heard the buzz about the People's Bank of China, PBOC, slashing its 5-year loan prime rate, LPR, by about 25 basis points. China's economic challenges have spurred policymakers and state-owned banks to explore various solutions. I've been fielding numerous inquiries and discussions on this topic, and I'm sure many of you are curious about its market implications too. Let's explore what this move could mean for the markets. As we can see in the charts, it revealed a notable disparity between the substantial increase in the cumulative floor space of commercial housing inventory and slower pace of sales. A trend also observed in other types of home. This imbalance have resulted in a significant overhang in the market, which persists to this day. China now confronts the possibility of a prolonged correction in its property sector, with excess inventory estimated to require more than 10 years to clear, as stated by Hao Hong, the chief economist and partner at Grow Investment Group. For years, Chinese home buyers held an unwavering belief that real estate was a surefire investment, making the property sector the cornerstone of the country's economy. However, over the past 2 years, as companies struggled with enormous debts and new home sales plummeted, Chinese consumers have displayed an equally steadfast belief that real estate has turned into a risky investment. This significant loss of confidence in property, which has long been the primary source of wealth for many Chinese families, poses a growing challenge for Chinese policymakers. Despite their efforts to revitalize struggling industry, including recent LPR cuts, they have seen limited success. According to the IMF, housing investments is likely to fall further and remain subdued. Investors tracking China's housing market recovery should closely monitor its 4 Tier 1 cities, which historically has served as the bellwethers for market trends. These cities tend to hit price bottoms earlier than Tier 2 and lower tier cities, typically leading broader markets movement by 1 to 5 months. For example, a significant 21% surge in new home prices in Tier 1 cities in 2015 spurred subsequent price increase of 15% in Tier 2 cities and 5% in low tier cities the following year. However, expecting a similar pattern to drive a home sales rebound this year appears unlikely due to persistent structural challenges such as housing oversupply, developers' liquidity concerns, and limited potential for home price appreciations amidst household pessimism. Despite increased policy support since September, new home sales in the 4 Tier 1 cities remained stagnant in January, hitting their lowest level in 6 years. In practical terms, mortgage interest adjustments are limited to once a year on a specific repricing day outlined in the mortgage contract. If LPR cuts occurs after this year's repricing day, the new rates won't take effect until the same day next year. For borrowers who set their repricing day on January 1, the LPR adjustment in February won't apply until 2025. A single 25 basis point cut in mortgage rate may not significantly elevate the debt burden. For example, for a family with 2.3 million yuan or $320,000 mortgage, which is the average mortgage in Taiwan cities according to Bloomberg Economics, a 25 basis point cuts may reduce monthly payments by about 250 yuan or $35 to 14,900 yuan. This accounts for only 2% of the average family's disposable income, assuming 2 income earners in the cities. The relief is even smaller in lower tier cities. Despite more than 100 basis points of cumulative easing in mortgage rates since the second half of 2023, the overall reduction in mortgage payment and subsequently the increase in spending power is significant. However, it may not be sufficient to persuade consumers to increase spending given the weak confidence and heightened concerns about job security and income, which may prompt them to prioritize increasing deposit savings instead. Further reductions in mortgage rates throughout the year could offer substantial relief for mortgage debt. Bloomberg economists anticipate the PBOC lowering its 1-year medium-term lending facility rate by 30 basis points over the remainder of 2024. If this occurs, there's potential for the 5-year LPR to drop by as much as 50 basis points. Based on this projection, we believe there's room for the spread between the 5-year LPR and 1-year LPR to narrow by up to 20 basis points. Even if the PBOC opts not to further cut the MLF rate, regulators may exert pressure on banks to lower lending rates to support growth. This aligns with government's directive emphasizing the financial sector's role in serving the real economy and its capacity to sacrifice profits for its benefits. February's LPR cut comes as a much-needed measure, signaling the government's commitment to further stimulus efforts. Particularly, following the PBOC's decision to maintain its key policy rate earlier this month. However, when these cuts provide some reassurance, it alone may not be sufficient to reverse the downturn in the property market and bolster China's struggling economy without more robust measures to boost fragile sentiment. The pressure on banks to maintain net interest margin may lead to incomplete pass-through of PBOC's rate cuts, disadvantaging mortgage borrowers. Hence, Taiwan cities have introduced extra measures to boost home buying, such as allowing non-home owners with a mortgage history to buy their first home since September 1, 2023. However, despite aggressive easing since September last year, both cities' house prices dropped 4% in January, trailing Shanghai 4% gain and Beijing's 1%. Money home sales in Guangzhou and Shenzhen from September to January were only 45% and 48% of the levels in the same period in 2021, indicating room for growth despite easing measures. Notable initiatives include Guangzhou lifting a home purchase ban for units larger than 120 square meters on January 27. Further stimulus measures were also unveiled in Beijing and Shenzhen recently on February 7, 2024. In essence, while the LPR cuts offer some relief in terms of debt, it falls short of restoring confidence sufficiently. Now the question arises, how might this scenario impact the stock market? The 5-year LPR holds significant sway over banks' net interest margins as it serves as the benchmark rate for a mortgage and substantial portion of medium to long-term corporate loans. These loans, which make up approximately 60% of total lending, typically carry high interest rates, thereby contributing more to banks' profits. With the recent substantial reduction in the 5-year LPR signals that banks will need to accept slimmer net interest margins, essentially squeezing their profits and putting a roof over banks' stock price. These profitability constraints impact banks' ability to manage risk effectively. With net interest margin already contracting significantly, there's little room left for further reductions in the 5-year LPR. As of the third quarter of 2023, the net interest margin had plummeted to 1.73 percentage points, making its lowest level since 2010. Just like our assessment, the PBOC is well aware of the margin squeeze and subsequent hurdles it creates for the transmission of monetary policy. Meanwhile, the CSI China Mainland Real Estate Index continues its downtrend without showing any signs of recovery at present. Although the interest rate cut is beneficial, economists argued that what the economy truly requires is an increase in government spending to stimulate growth and a more vigorous initiative to resolve China's prolonged real estate challenges. Thanks for joining me today. I hope you have gained insights from today's video. Everything I've shared are informations that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, please subscribe, share, and like. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.